The IRS due diligence penalty is a preparer penalty, not a taxpayer penalty. It hits when you fail the due diligence requirements on a return that claims EITC, CTC or ACTC, AOTC, AOTC, or head of household. On the EA exam, they love asking who gets penalized and what triggers it. The key is, it's tied to specific refundable credits and HOH status. Here's the number you need to memorize and then update by year. For tax returns filed in 2024, meaning 2023 tax year returns, the penalty is $600 per failure. For tax returns filed in 2025, meaning 2024 tax year returns, it's $635 per failure. It's adjusted for inflation, so the exam may test the concept even if the exact dollar changes. The part that gets expensive fast is how it applies. This penalty applies per credit, and there is no maximum dollar cap. So one return can generate multiple penalties if multiple items are claimed and you fail due diligence for each one. Exam tip: when you see EITC plus AOTC plus HOH, your brain should immediately think stacking penalties. Let's do quick exposure math. Suppose a 2024 filed return claims EITC, AOTC, and HOH, and you failed due diligence on all three. That's 3 failures times $600 or $1,800. If it's filed in 2025, use $635. So 3 times $635 is $1,905. The exam isn't trying to trick you. Just multiply the number of failures by the per failure amount. Now the professional fallout. If the IRS finds you didn't meet due diligence, the $600 plus penalty may be the beginning, not the end. You can face discipline by OPR, including censure, suspension, or disbarment. You can also be suspended or expelled from IRS e-file. And in serious patterns, the IRS can seek an injunction to stop you from preparing returns at all. The IRS also has streamlined procedures to refer bad actors faster to the Department of Justice, especially around fraudulent refund claims. That can lead to temporary or permanent bans from federal tax preparation. On the EA exam, watch for wording like pattern, willful, or fraudulent claims. That's your cue. The question is moving beyond a simple per-return penalty into enforcement actions. Finally, don't forget the taxpayer consequences when a credit or HOH is disallowed. The taxpayer must repay the amount in error with interest. They may have to file Form 8862 to claim certain credits again after disallowance. And there are bans: 2 years if the IRS finds reckless or intentional disregard, and 10 years if the IRS finds fraud. Those bans are a favorite exam detail. Bianca is an enrolled agent who gets audited after a former client reports possible misconduct. The examiner finds she understated tax on several returns due to reckless misconduct and willfully ignoring the law. Under IRC Section 6694B, what's the potential penalty? The choices include different dollar minimums and different percentages of the income she derived from the returns. Think about it. The correct answer is the greater of $5,000 or 75% of the income derived with respect to each return or claim for refund. That's IRC 6694B, willful understatement or reckless or intentional disregard. A tempting wrong choice is the one that says 100% of income because it sounds harsher, but the statute uses 75% with the $5,000 minimum. Which of the following is an offense that could lead to practitioner sanctions by OPR under Circular 230? The options use similar sounding phrases like gross negligence, gross incompetence, gross delinquency, and gross recklessness. Which one is actually recognized as a basis for OPR discipline? Think about it. The correct answer is gross incompetence. Circular 230 allows OPR to censure, suspend, or disbar practitioners for incompetence and disreputable conduct, and gross incompetence is a recognized basis. The tempting wrong answer is gross negligence, because it's a real legal concept, but it's not the specific Circular 230 phrasing they're looking for here.